Your conference is being recorded.
Good afternoon, ladies and gentlemen. I'm Vidya, moderator for the conference call today. Welcome to Concall Q3 FY23 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participants will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone telephone. Please note, this conference is recorded. I would now like to hand over the floor to Ms. Bhumika Nair from DAM Capital. Thank you, and over to you, ma'am.
Yeah, thank you. Good afternoon, everyone. Welcome to the Q3 FY23 earnings call of Container Corporation of India. We have the management today being represented by Mr. V. Kalyanarama, Chairman and Managing Director. I'll hand over the floor to him for his initial remarks, post which we'll open up the floor for Q&A. Over to you, sir.
Yeah, thank you, Bhumika. Good afternoon, everyone. Thank you for being with us for the post-results conference call. This quarter, we had both a mixed bag with us. It's a little difficult in exim sector. We had the quarter, some numbers dropping, margins, there was little pressure on margins. In domestic, we did well. And overall, yes, there will be a pressure on margin because domestic margins are definitely not as good as exim margins. As we all know, because within India, logistics are very competitive logistics, competing with the road. So the overall margin figures have come down a little bit. But the good thing is domestic growth is continuously there. As we've seen last year, 30% plus growth. This year we are seeing the same growth continuing, 30% plus. But again, the difficulty in this scenario is that we are having now resource constraint. We are not able to add new containers, new rigs because of some geopolitical problems, which restricted us from importing containers from China. So even though we got a good demand for domestic containers, we got stuck up at 37,000 containers. So we are running a program to develop container manufacturers and Atmanirbhar Bharat. As all of you know that we released a lot of container manufacturing orders. 18,000 container orders we released. But as all of us know, any ecosystem to develop, तो टाइम लगेगा ही उसका. तो ये इकोसिस्टम डेवलपमेंट अभी हो रहा है. उस वजह से अभी तक हम लोग को सिर्फ 100 से 150 कंटेनर ही मिल पाया आउट ऑफ 18,000. Even though they're supposed to get almost as per the schedule given in the tenders, we have to get 9,000, but these things are expected. But the demand, on the demand side, if I see, and how many more containers are required at this moment is something like another 20,000. So 37,000 today we are owning. So we can own now around 60,000 containers, and all containers will be full, and they'll be utilized fully well. So that sort of demand is there. So the overall scenario is very positive when you look at the macro picture. There's a very positive outlook for Indian logistics companies, and particularly for your company, Concall. It is very, very bright future there. In the next 4 or 5 years, we are expecting a lot of growth in domestic. And the important part which all of us here should know, the domestic revenues, which used to be 20% of total revenues in the year 2015-16, and that was traditional 80-20 mix of the total revenue. Today it is come in this quarter to 65-35, and it will further grow. So domestic, now to protect our margins, what we are doing is we are adding value-added services very aggressively into the domestic market. FMLM is already there, which we are continuously trying to increase our numbers into FMLM. Now we are trying to give that, including with providing FMLM along with the transportation, rail transportation. We are now trying to do the complete business solution, and that we want to bring into the domestic sector. We are offering these complete business solutions to some of the major industries, like government side, FCI, we are providing a business solution service. Food industries, we are providing business solution service where it is from business to government, B2G service, that one. So we are providing a business solution there. So our endeavor is to increase this. So for that, now we are trying to add more resources. We are now trying to add LNG trucks. The issues under very active consideration. So we will be experimenting with the LNG trucks first at our major hub, Katwas, and then we will be expanding it to all the big terminals. So all these new things we are bringing in to add, because the demand is there in domestic, and also to encourage more and more domestic traffic into containers, and to add the value-added services and to make it a complete business solution, which will increase our margins so that the overall margin pressure will not be too much. As I mentioned to you last time, as domestic increases, there will be definitely any pressure on margin, which I think this time every analyst is, maybe all of you are also calculated, and every analyst commenting on that is that overall margin has come down by around 200 to 300 basis points. The reason is that. But in domestic, the bulk cement, which we started, and we started commercial runs during this quarter, is picking up very well. Till the date, we almost completed 50,000 tons of domestic bulk cement movement. The market is huge. Because of, again, the resource constraint, we are not going aggressive into this. As soon as we will add some more containers, we are working on that to add some good number of containers in the next quarter itself. So as it happens, I will let all of you know how much we added and how we added. Now to give any details on that will be too premature, so I'm not sharing anything on that with you guys. But once we add, there is a huge demand in bulk cement, and bulk cement is a complete business solution model, and we are working on that. As of now, FMLM, we are not into that sector, but we will add FMLM into that sector and make a complete business. So this is the domestic scenario. And the EXIM side, yes, we have started seeing dropping our share, in particularly at two ports. One, Mundra port in imports, we got our share dropped. And in Pipavav, the export side, our share got dropped. So we analyzed and now introduced new schemes in the month of November. And the scheme on the import side is 1+1, and on the export side, obviously, that export will be followed of more imports and the empty repositionings. And all of you know that empty repositioning or scheme of 50% is continuing, and it is giving good results to us. Now with 1+1 scheme which we gave, with every one extra import load given by the shipping lines, we are giving them one free transport of empty repositioning from port to interland and discounted repositioning terminal to terminal. So this scheme in December has given us very good results. So when I see December month as separate from the quarter, in December our volumes picked up at all the ports. Mundra, Pipavav, both our share started going up, and I'm expecting this trend will continue because in January also we are seeing the same traction continuing in the ports. So we are hopeful that the scheme started working, and this scheme, and it generated a lot of interest among all our customers. So we are hopeful that we will be getting back our share, which and as all of you know, we will not be going for price war to get any share. Will not reduce our margin. That is our principle, and we stand by that. So without giving away the margins, we are now trying to come back with the VDS scheme. And let me tell you, all the VDS schemes are net positive VDS schemes for the company, for Concall. That is how we design. It is a win-win situation for both the customer and for the company. So this in EXIM Q4, We're expecting that we will be able to get back some of the lost share, and we will be able to get good numbers in Q4. On revenue side, as you see, because domestic we did very well, overall revenue we are positive, and the even PAT side we are positive. Yes, on the absolute numbers we are positive, but on the percentage-wise margins, when we look at it, yes, as already explained, there is a dip in the percentage margin. Otherwise, the scenario, as I said, macro scenario is very good, very bright future. So I don't see any problem. And some of the other important, interesting parameters which many of you asked, let me give you those numbers. Double stack, we are doing very well. We already crossed 3,000 double stack trains in this year for the 9 months. And this year we are expecting to cross more than 4,000 trains. It's a record. We are using double hub. Swaroopganj has really picked up as the second hub. So almost all the JNPT volumes we are bringing and doing the double stack. So, and Kathuwas is doing extremely well. So double stack side, there's a good growth, and as planned, things are moving on. On the rate reduction, because of the geopolitical constraint and the increased demand in the railway sector, we are not getting the wheel and axle. So we now started working on alternative sources, and we are establishing supply chains. And we are hopeful that these supply chains will get established in 2-3 months' time. It's not very long gestation supply chain establishment. So with that, we are hopeful we'll be able to start adding rates from the first quarter of the next financial year. So this year, our program of adding around 45 to 48 rates got really hit, and that is showing us and we are under severe constraint to meet all the demand. Even the EXIM we are losing percentage, but today the position is that our rates are not available to meet the demand from the EXIM and from the domestic. And I already told you about the domestic containers. Equipment, same issue. Equipment restackers, again, because of the geopolitical problem, we are not able to import from China. Indian manufacturers are not able to meet the demand. So we are working out various methods. It's premature to share with you at this moment what are the strategies, but as and when we were able to finalize and we'll definitely share with you the details of how we did this. So we are working on increasing our handling machines, containers, rakes, and I'm sure in the next quarter itself we will be able to find solutions so that for the next financial year we are positioned very well to meet the increasing demand, and all the expected demand without losing any customer and maintaining the customer satisfaction with our motto of customer value creation. Thank you. Yeah, you can start the question answer session.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. We will wait for a moment while the question queue assembles. The first question comes from Atul Tiwari from Citigroup. Please go ahead with your question.
Yes, sir. Thanks a lot. Sir, could you share originating EXIM volumes and domestic volumes?
For Q3, the originating EXIM volume was 465,107 TEUs, and domestic volume was 109,479 TEUs. Total 574,586 TEUs.
Okay, sir. And sir, it looks like that the decline in the originating volume on the EXIM side was almost like 15% year on year, and you did refer to some loss of market share. So what would be current market share on the EXIM side, and can you give some more color on who is gaining market share in the industry, and You did refer to some measures that you have taken without loss of margins. So how does that work? How do you gain back market share without ceding some margins? So any color on that will be useful.
Hey, Tiwari, I already told you the total market share we lost over the last financial year, if I look at the 9 months figure, is 2.84%. So in million tons, that is in million tons. So the market share in EXIM, we lost around 4%. It was 62.7, it has come down to 58.3 when I look at all. In this, there are two factors in this, which I repeatedly tell you guys, that in JNPT, there is a short lead traffic which we are not interested. So if I leave out the short lead traffic, where there are no margins at all, our share increased. Our share increased at JNPT. We have gone up by 3% from 76.3 to 79.75. That's 80% what we used to do. Mundra, we lost a lot of volume. We have come down from 45 to 38. And in Putawa also, when I put both import-export together, we lost percentage. Now, in import side, I already explained to you what scheme we have given. They are giving 1+1. After a threshold of import volume for any additional import load shipping line give me, I will be allowing one empty free transport from port to the hinterland or discounted transport within terminal. But when we do the schemes, we do it net positive scheme. You understand what is net positive, I think?
Yeah, yes.
So when it becomes net positive, there is no loss of margin.
Okay, sir. Okay, sir. Thank you.
Yes.
Thank you, sir. The next question comes from Amit Dixit from Edelweiss. Please go ahead with your question.
Yeah, hi. Good afternoon, everyone, and thanks for taking my question. I have a couple of questions. The first one is on the margin trajectory. You mentioned that the domestic revenue would be 35% in the future and will grow further. So, can you share with us the margin trajectory? Usually, our margins have been like 23.5.
We are not going to do any forecasting on margins, but as in when domestic margins, we work around 18%. And in EXIM, we work with the margins of almost 26%. So when the domestic volume grows and domestic numbers keep growing, so there will be pressure on the total margin. In absolute numbers, it will increase, but on the percentage-wise, if you see, the margins will be coming down. Our top line will be growing quicker than our bottom line.
Okay, sir. Got it. The second question is on the empty running cost, if you can share for this quarter between EXIM and domestic both.
Empty running cost.
Yes.
Empty running cost for the quarter, you want. The empty running cost for the quarter 3 is EXIM 37 crores, domestic 97 crores.
Okay, sir. Thank you so much and all the best.
Thank you, sir. The next question comes from Achal Lohade from JM Financial. Please go ahead with your question.
Thank you for the opportunity. Sir, in terms of the employee cost, can you help us understand there is an increased QOQ? Is there any one-off in employee cost or this is a recurring employee cost?
The employee cost, whenever there is increase, there is definitely a one-off benefit we pass on to our employees. We increase our employees because now our workforce, we are the, I think the best lean company in the logistics sector. Whether you compare it with anybody. So the employee cost increases because of basic pay increase, that and DA increase. What happens that comes over the quarter on quarter they will be increasing. So every quarter there is a DA increase and basic 3% increases for everyone. That increase will be there. And last quarter we have given a good incentive to all our employees. So that incentive also is there in this. So these two things. One of benefit is the incentive to the employees. The other thing is the regular increase of basic cost.
Would you be able to quantify how much was the increase?
Yeah, these are too small numbers for the analyst to quantify. It doesn't get any result impact on the total figures. Employee cost increase. What is the increase you are seeing? You tell me. How much increase you are seeing in 9 months? You know what is the increase given to the employees in 9 months?
Hello, sir. Sorry for interrupting you, sir. There is background noise from your line. Can you just disconnect the line and come back in the queue, sir?
Am I audible now?
Yes,
sir.
yes.
Yeah, it's 3%. Okay. Sorry, I couldn't.
Analyze the employee benefit cost. Do you know how much by absolute number the employee benefit cost increased in 9 months?
Understood, sir. Any clarification on the other income, which is at 113 crores?
No.
It's up 80% YY, sir.
Yeah, other income we have the income from the deposits on investment which we get, and then the rental incomes and the dividends we get from subsidiaries. So there is always some variation from quarter to quarter. So that is the reason, some dividends we have got in this quarter and some, rental income increase is there. So on this account, there is an increase in the other income.
But overall, 9 months, it is okay.
No, 9 months it's not, but 24 crores.
Understood. And just a clarification, sir, you said 18% EBIT, 18% margin for domestic and 26% for EXIM. Was that at EBITDA level, EBIT level, sir?
Yeah. Yes, yes.
It was at EBIT level, sir?
EBIT level.
Got it. Thank you so much. I'll come back in the queue.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. I repeat, ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. The next question comes from Ashish Shah from Centrum Broking. Please go ahead with your question.
Yeah, thank you. Good afternoon, sir. So my question is on the EBIT margin for the EXIM business. So you did say that in December we have introduced certain schemes and they would be, margin accretive, or at least they won't, deplete the margin. Then why would the margin in Q3 would be lower than, let's say, the previous margins? Is it only because of the decline in the volume, or there could be some other reason?
You are saying EXIM margin separately or overall margin?
EXIM margin, sir. When I look at the EXIM EBIT margins for the segment, EXIM margin,
overall
sir.
Margin you are talking of, EBIT margin, isn't it?
EXIM margin, sir. EXIM. Hello?
EXIM?
Yes, sir. EXIM margin.
What are your numbers? Let me have these numbers, what you are talking of.
So, sir, in the second quarter, we had EBIT margin of 25.2% for the EXIM segment. In the third quarter, we have 23.3. In the first quarter, it was 24.4. So I'm referring to the absolute EBIT is 295 crore for the third quarter, whereas it was around 320 and 330 for the first and the second quarters.
So in the EXIM, in the EBIT margins, the one factor which affected us is the increase in the empty running, which happened in this
Right.
quarter. Okay. and there
Okay.
is a drop in the volume. So we lost
Right.
some of the long lead traffic which we are carrying, and East Coast we don't lose much of traffic because there is not much of competition. So the competition comes only on the West Coast. So West Coast is long lead traffic. So there is a slight dip. So this dip of, you are talking of a dip of 37 crores.
Right. Right, sir. Got it, sir. Sir, secondly, just a little bit on the CapEx numbers. So, how much we would have done for the 9-month period, and what would be the CapEx target for this year and possibly maybe next year as well?
The CapEx, there are constraints. I think I talked lengthy about
Right.
the constraints what we are facing, isn't it? So
Right,
out of
right,
the
sir.
CapEx program, a lot of CapEx we want to spend on containers and rolling stock and handling equipment. And all the three things we are having constraints. So,
Right.
in fact, I think 2-3 quarters back, when I said we are going to spend the capex of almost 10,000 crores, that's our program. I think analysts got worried how this much of capex is getting spent. It will be spent. See, that is the demand available in the market for the logistics sector. But today, because of the constraints, we are not able to spend the thing on these three things. So whatever capex is being spent on only the terminal development.
Right. So, any number you could leave us with for this year and next year?
Here, till now, we could spend 220 crores.
Okay. Fine. So last question on the LLF side. So we have been doing roughly 96 crores a quarter. Where would we be ending 23 with? It would be around 400 crores, or because earlier we have probably given a range of 400, 450.
This question I answered many times. There is no change in my answer. It is 450 crores we take for our balance sheet. There will be
Okay, for 23. Yeah.
Yes, 450 crores.
Right, sir.
There will be adjustments in the last quarter because there are some calculations which railways will be doing, we will be doing. So you have to, do these sort of adjustments in the last quarter. So we always keep that figure 450 crores. Please take that in your analysis. Because see, the analysis will not change for 10-20 crores. Some of the questions people are asking me for 10-20 crores, whether it increase, decrease. On a PAT, when we are projecting a PAT of 1,200 crores for this year, does it change anything with the 10-20 crores here and there?
Right, sir. It won't change. Correct. Got that, sir. I just wanted that indicative number of 450. Fine, sir. Thank you. Thank you.
Thank you, sir. The next question comes from Gasal Gupta from JM Financial. Please go ahead.
Hi, sir. Thanks for taking my question. I just have one question on the rail freight expenses. So if I look at it as a percentage of sales, usually in the past, the range has been 54 to 55%. But for this quarter, it is 57% approximately. So just wanted to understand why this increase is there for this particular quarter.
Railway has withdrawn two discounts. One, 25% of empty movement discount and 5% on loaded movement discount.
Okay. That's all from my end. Thank you.
Okay.
Thank you, ma'am. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. The next question comes from Mukesh Saraf from Avendus Spark. Please go ahead.
Yes, sir. Good afternoon, and thank you for the opportunity. My first question is relating to the market share loss that you had mentioned. Could you just give us some sense on the reason for this market share loss? Is it just pricing competition from competitors, or is there some other reasons?
Mainly pricing competition. Because
okay.
People are working with almost nil margin basis, so we never do that.
Okay. Okay. That's the
As I
primary reason.
mentioned, from December we started picking up our market share.
All right. All right. Understood, sir. And secondly, what would be the rail freight margins for us in the quarter?
Rail freight margin this quarter is 25.3%.
25.3. Okay. So the first half it was around 26.5%. So there is a decline there.
But there is an empty running cost is increasing because I already mentioned that and we have to do a lot of tracking of rates and assets to meet the demand from customers. Second, railway has withdrawn the discounts given for empty movement and loaded movement both.
Sure. So we will be passing through this.
Yes, go ahead.
Sorry. So what I was asking is, we will be passing this through to the end customers, which might take some time for it to.
This was done long back. This is not now. This is withdrawn 6 months back. Right? We are not passing on. See, our pricing is totally market driven. It's nothing to do with railway pricing. Okay.
Because previously you had mentioned that it might take some time for the pass through to get into effect. Might take 6 to 9 months. So I was just wondering.
See, my pass through will be market driven. That's what I'm telling you. When I say pricing is market driven, whenever market can take and I feel that I can increase prices without losing my market share, I'll do that.
Sure. Right. All right, sir. Thanks a lot for this.
Okay, thank you.
Thank you, sir. The next question comes from Vikram Suryavanshi from Phillip Capital. Please go ahead.
Good afternoon, sir. Some questions are already answered, but just for bookkeeping, then can you get lead distance for EXIM and domestic for this quarter?
The EXIM lead is 676 and domestic is 1370.
Okay. And sir, basically, if you look at, you mentioned that double stacking trains will cross to more than 4,000 this year, but what was the number for this quarter, third quarter number?
Third quarter number is 880.
So with this increase in double stacking, are we able to get this advantage which can compensate for pressure on the removal of these discounts and all that, and probably maintain the margin with, or to what extent we can have further scope for increasing the double stacking trains, which can really relieve some pressure on the margin?
Last year we did double stacking of 3,750 trains. This year we are targeting double stacking of 4,000 plus. So the increase in double stack will not be very high to take care of the margins drop because of the increase in the rail freight by Indian Railways.
Mm-hmm. And they have manufacturing in Bangladesh. Got it. And since we are seeing very strong growth in the domestic market, and so how is the development happening for third party or contract logistic services, what we were planning? So how is that pick up in these kind of business opportunities?
Which one? Contract?
Or end-to-end logistic services, what we are looking for domestic operation with the partnership and all.
All the programs, like I was talking about movement of bulk in containers. We already started the cement and it is really picking up very well. It's a very successful solution, doing cement in normal GP containers. So we already moved, as I mentioned, 50,000 tons till now. But we are not aggressively going on because of our constraints in our SAs. And the DLC, distribution logistics centers, we are pursuing that and it will definitely come out. We are now almost working on giving at least 12 OIs. end-to-end now FMLM services we established. Now we are working on giving the business solution, a complete solution to customer from end-to-end logistics.
Okay. Thank you very much.
Thank you.
Thank you, sir. The next question comes from Kaundinya from JP Morgan. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sorry, I got disconnected briefly. I'm not sure if you have already answered this question. Apologies if I'm asking it again. Sir, I was just looking at the railway charge. If I look at it on a per sales basis or on per TU basis, it looks slightly high. Is it all along due to the discontinuation of discounts by railways, or is there something else that I should read into it?
No, it is because railways is on the discount, so we have not changed. We have not increased our rates. So railway charges will increase. So our rail freight margins will slightly dip.
Sir, so in that case, is the number that we are seeing 3Q a sustainable number, or can we see some sort of improvement or something on this?
Which number?
That 57% of sales or around 19,700 on per TU basis. So.
Which one, yeah? What is that margin you are talking of?
Sir, I'm speaking about the railway charges on per sales. When I look at the number, that's around 57%.
Analysis. Our analysis, you do everything. I will not be doing. No, I do my own analysis, and I have given you the macro figure that the future is good, and the EBITDA margins we will be able to maintain. But with the domestic increase, EBITDA margins will little bit come down. Absolute numbers will increase.
Okay. Sure, sir. And sir, secondly, on the capex front, if I look at it, because this year we couldn't do much of it. So what is the reasonable?
But I think because you got disconnected, for your benefit, let me repeat. See, in capex front, there are 4 elements. One is rakes, containers, equipment, then IT, land, and terminal development. So the land and terminal development, in our original program itself, it's not very much, because now we are now trying to develop a asset-light model, because Concall is in a position now to go for a franchisee model business because of its name and its popularity and the reach we got. On the equipment side, our containers, rolling stock, there are geopolitical constraints. There are various constraints which are actually creating problem for us in our procurement programs. This year we could not procure none of them. That capital expense we could not incur. So this year, even though we projected 650 crores around capex program, we could spend only 220 crores in 9 months. So we are working on easing out these constraints for these 3 equipment, container, and rake procurement. We are hopeful that maybe we will be able to do something in the next quarter. Then only the capex will become.
Sure, sir. Got it. Thank you very much.
Thank you, sir. The next question comes from Indrajit Bhatia from HDFC Securities. Please go ahead.
Yeah, hi sir. Thanks a lot for the opportunity. Just one question. Since the new LLF policy has come out, would you want to share some insights as to what you think Concall would do with some of its more profitable terminals? Would you want to go through a bidding kind of a system, or want to retain this at the existing LLF kind of structures?
Our business is well set with the existing LLF model. So we will not be doing any immediate changes in our LLF models. We will be continuously analyzing our scenarios, and if we feel that any place we can go for bidding, we will do that. Otherwise, that is a risky proposition. An established business putting it to a bid, somebody can play a spoil sport with us.
So that means in the base case 450 crores, and then on top of it, whatever escalation prescribed in LLF should be the number that we should work with.
I can't do a guesswork for you. That is your job.
No, okay, no worries. Thank you, sir.
Thank you, sir. The next question comes from Deepak Krishnan from Macquarie. Please go ahead.
Yeah. Thank you for the opportunity. Sir, I wanted to understand the rail coefficient at the 3 ports, JNPT, Mundra, and Pipavav.
rail coefficient of the total port.
Of the three ports, so 18.2% at JNPT, 26% at Mundra, and 70% was the rail share at each of these three ports. Could you give a similar number for Q3?
The Q3 number is not available with me. I can give you for 9 months.
Sure, 9-month number will also be fine.
Then our people will reply to you. For 9 months, JNPT rail coefficient is 18.13%, Mundra 25.55, and PPS, Pipava is 66.
Sure, sir. So maybe just a follow-up question on this. So probably we have the DFC leg at least between, say, Rewari and Palanpur operational for the last 6 months odd, but we've not really seen any jump in rail coefficient or, rail originating volumes, and as a result, even your originating volumes. Anything that you would want to attribute as to, why originating volumes are decreasing when DFC is getting commissioned?
I am not able to correlate the things what you are asking me.
Sir, your EXIM volumes are down 15% originating.
Also down. I already given reasons why they are down.
And rail share is flat.
Is not increasing. The whole business is in India is going through some, the import-export volumes are not grown as we thought of, isn't it?
Yes, sir.
So, rail coefficient, if somebody is feeling that DFC comes, it will jump just like that, it will not. So, the ecosystem development also will take time.
Sure, sir.
There is a trend of moving from road to rail in certain sectors where DFC is serving.
Okay.
That much I can share with you guys.
Sure. Okay, sir. That was my question. Thank you for the opportunity.
Yeah.
Thank you, sir. The next question comes from Aditya from Kotak Securities. Please go ahead.
Yes, sir. Good afternoon, everyone, and thank you for the opportunity. So you did share about the Mundra market share for the company at about 38%. What would be the number of Pipavav, sir, for you? The market share for third quarter?
I got full 9 months figures. I don't maintain
Sure.
quarter-wise figures because that doesn't matter to me. My total overall 9 months figure for Mundra is 39% and for Pipava it is 48%. This is what
2820. You said 28%, right? Okay.
Yes.
So, sir, these numbers have declined.
I have not said 28. For Mundra it is 39 and Pipava it is 48.
48. Okay. So, sir, the second question was that there has been some amount of meaningful decline happening in Pipavav and Mundra, and you are saying that a reversal is happening in December. Can we completely recoup whatever market share we have lost over the last 1 year? Have we seen that happening in December and January?
In 1 quarter, entire thing for the 3 quarters, well, whether I will do it or not is, I don't want to do a guesswork on that, but when I see the reversal, that is a good thing for me. See, when
Understood.
I can see a reversal without cutting out my margin, that is the best thing I can do, and that is the best thing any company can achieve.
Understood, sir. So the next question that I had was more on these announcements that we are hearing of ICDs coming up near your ICDs. I can recall ICDs coming near your ICDs. So let's say in Dadri, in Moradabad, and in Jaipur or Kanakpura, there are competing terminals coming up. Just wanted to get a sense from you whether that would lead to, are these
Look, Aditya, these are very guesswork questions which you people try to give, some sort of forecasting. See, what I can share with you, when I took over as CMD in 2016, long back, okay, there were announcements that there will be 35 MMLPs will be made by some different government agencies. Now, can you tell me how many MMLPs have come up till now?
No, it's not been great going for them yet.
How many have come up? You follow the sector very closely.
Wouldn't want to hazard a guess, sir, but yeah, that's small number. It's an insignificant number.
So these guesswork questions, no, let them come. See, we got our own strategies. So whenever we face competition, we know how to withstand the competition.
Well, I was just coming to this question, sir, that given the fact that there has been market share decline, is there a rethink on the pricing front or not? Or will there be a rethink on the pricing front or not?
Will there be?
A rethink on the way we price and on a certain margins for our services.
We do our pricing. You see, it's not, when I am telling that I have come up with some scheme, 1+1 scheme, is it not a pricing scheme? Is it something different?
This is something.
What do you call it?
Fair point.
The pricing Whenever I do a pricing scheme, I mention this, we do a net positive pricing schemes. So that, I will not tell you how we do it, but that is our specialty. We never lose margins because of any of these pricing schemes.
Fine, sir. So just a last question from my side. Are all ambiguities linked to the land license fee policy from the railways completely cleared now, sir, or are there still some ambiguities that you have to clarify with the railway?
From the railway side, the land licensing policy is now clear, and that is why I answered one of the questions which you must have had, that our figure LLF for this year is 450 crores. Whether we are completely putting 450 crores on the balance sheet or less or little more, that depends on the final adjustments of the land values by railways, by us, because we depend on revenue authorities to give us the land values.
Yes, so I'm also assuming that when you're saying this, that on this dichotomy, whether to go to 1.6, at least the rules are very, very clear. Whether you want to go for 1.5 and bid for it is a separate thing, but there is no ambiguity over there, right?
There is no ambiguity. There are certain conditions in that. So then it is our call whether we take that or not. So a settled business where I am running this company well, giving a PAT of 1,200 crores for this FI, expected PAT, why should I take a risk of established business putting on a block? So I will take a call, the management will take a call, and in discussion with our board of directors, that is what I mentioned.
Thank you, sir. This is very helpful. Thank you for this. Those are my questions.
Yeah.
Thank you, sir. The next question comes from Pulkit Badini from Goldman Sachs. Please go ahead.
Sir, thank you. Sir, firstly, originating volumes I completely missed. It was spoken so fast. If I could have the numbers again, please.
You send a mail, we will give you.
Sir, please tell this because the mails don't get answered. It will be helpful. It's just two numbers I'm asking for.
You write a personal mail to me. If your mails are not getting answered, you write a personal mail.
Okay, I'll do that, sir. So secondly, given that you mentioned that it takes time to develop the ecosystem, is it fair to assume that next year also our capex is going to be much lesser than the typical run rate that we are envisaging?
No. We are going to develop the ecosystem next quarter. We are confident of that.
So our capex for FY24 that we should be building in should be in the range of?
The next FY?
Yes, sir, next FY.
It will be a good number.
Okay, sir. Thank you.
Normally so much in advance any numbers, you know that, so it will be definitely a good number.
Okay, sir. Thank you.
Thank you, sir. We have a follow-up question from Achal Lohade from JM Financial. Please go ahead.
Thank you for the follow-up, sir. If you could help on 9 months FY23 in terms of JNPT, PICA, and so on and so forth.
Already given here. These numbers you send a mail.
All right, sir. And just a clarification on the margins. You said the EBIT margins for domestic segment, you kind of target 18%, but if I look at third quarter FY23, that margin is closer to 6%. So just sort of understanding, how do we...
What 6%? Where from you got 6%? I don't know. We work on EBIT margins of 18% in domestic.
So 43 crores on 719 crores of revenue.
There's not debating platform. You send your mail and our finance director and ED finance will answer all your questions. Okay.
Sure, sir. We will do that. Thank you.
Thank you, sir. That will be the
Okay,
last
I think
question for today.
now the questions are over. We may close the conference.
Okay, sir. Thank you, sir. Now I hand over the floor to Ms. Bhumika Nair from DAM Capital for the closing comments.
Yes, sir. Thank you very much for giving us an opportunity to host you and also answering all the queries. Thank you to all the participants and wishing you all the best, sir.
Thank you, ma'am. Thank you, sir. Ladies and gentlemen, this concludes your conference for today. Thank you for your participation and for using Doorsaba's conference call service. You may disconnect your lines now. Thank you and have a pleasant evening.